Joining me is Mark Avallone. He's president of Potomac Wealth Advisors. Must be snowy where you are, Mark.
It is, and it's quite nice, actually.
Yeah, it is beautiful when you don't really have to deal with it because you can work from home and all the rest of it. So I am very curious for your thoughts on the market. What does this PE say to you?
Well, I think the PE is just one measure of a lot of different variables. It's a fair metric. We want to look at it. We're also wondering why the PE has dropped and why some of the expectations have dropped. And we think a lot of it is because we're going to get less Fed stimulus. As we know, the bond buying is reduced. They may raise rates. We could talk about that. But we're going to get a lot less federal stimulus. And to underestimate how Congress has played a role in this rally would be foolish, because they literally put money in people's pockets, increased consumer demand, spending. That's what's spiraling this inflation hike. So when the federal government's going to pull back on stimulus, the repercussions are going to be real. And I think that's one of the reasons growth will moderate at least towards the second half of this year.
But does that leave you bearish or bullish on the markets?
Modestly optimistic, expecting high single-digit returns for the year. Several reasons for that. Earnings are still strong. The consumer is still strong. And we're also looking at no alternative for investors. I have to put money to work today, and to think about putting it in long-dated bonds and treasuries and high-quality credit puts me at an extreme risk for interest rate hikes. And since interest rates will likely tick up, we don't think they'll be out of control, but even a modest move in interest rates can hurt bond prices. So we're going to remain invested, as many investors are. It's the old Tina trade that has not gone away.
What do you make of the spike in bond yields to start off the year? Again, spike relatively speaking. We're still around 160 on the 10-year.
I think it's going to move back up to that 1.7 range and stay there for a while. If we get north of 2, we think that's the hard ceiling. Look, as the Fed reduces bond purchases, and then if they raise rates at all, it's going to have a counter-cyclical effect to the economy. So will higher energy prices. So will the increased regulations we're seeing. So are potentially higher taxes. This supply bubble will work itself out. And we think that the inventories that are then on hand, all of that will put a negative, albeit a modest one, impact onto economic growth. And we're going to see GDP by the end of the year moderate into the 3, maybe a 4% on the upper range, but it's going to measure the economy's growth. And we think that interest rates will spike up to maybe the 2% range, but they're going to hit a ceiling there, and the Fed may even lose its nerve at that point if the economy's growth slows enough.
Why do you like Truist and Sandy Spring Bank? And I'm curious what your view on inflation is if you're in the camp that thinks growth is going to be moderating.
Well, we like financials, and we like banks, and we like regional banks for the reasons I've been discussing. A modest rise in rates and a moderately strong economic growth scenario is almost ideal for banks. Remember, banks lose money when people don't pay back their loans. If the economy is strong enough and credit defaults are low, that's always a boost for banks. You add rising interest rates, it helps their operating profits and their margins widen. Those are two huge factors. Then we look at banks that are well managed in strong areas of the country. Both of the names you mentioned are in the Washington, D.C. area in a big way, and or the Southeast like Truist. And they're going to have favorable demographics. They're having economic growth. They're the ones seeing populations increase. So that's why we're favorable on banks. And it's consistent with our outlook on modest inflation and modest interest rate hikes.
You seem to think that the high multiple names could face some more downside. What are you looking at, and when are you going to strike?
Well, we've talked about that for a while now, that where we want to be in technology is cash flowing technology. And we've also talked about how a slight rise in rates will not hurt big mega tech that has strong cash flow. And that has proven to be the case. And we've also said higher rates hurt unproven companies. And that's also proven to be the case. We still think it's too early to jump back in to a lot of the names that got pummeled, whether it's names like a Teladoc and Zoom, and you could see that today even. We're surprised that some of the cloud companies are getting hit.
Yeah.
That's a sector we think we're going to see more CapEx spending and potential growth, but some of these companies aren't as proven, and I think proven technology is where investors should be, and I think we should continue to wait to see more of a firmer bottom before going into the speculative names.
All right, Mark, thanks very much for your time today. We appreciate it.
Shepard Smith here. Thanks for watching CNBC on YouTube.